Okay, guys, I think let's kick off. As guys come in, then that's fine. They can join. Uh, I think firstly, thanks for making the time this evening to come through. I know it was a bit last minute. We had to move, I think, a couple of things that we are on. So I think there were some clashes with the diary, but I'm glad we made it work. We chose this time because I know there's quite a few doctors in the audience, just to allow for their time in terms of seeing patients and theater and coming back home and at least having a couple of minutes to recover and de-stress before jumping on this call. So I do appreciate the time that you're putting in. So today, I think Murthy has given a bit of a brief in terms of what we'll be chatting about, and it's the Renewable Energy Fund. So we've got a Renewable Energy Fund, and it's a great opportunity. It's I think timely in terms of the tax year, and obviously it's got a big tax benefit aligned to it. As I said, it's a renewable energy fund, and I think the good thing about it is that it allows individual investors, because that's who it's targeted at. So individual investors to enter this renewable energy market. And we've done quite a bit of work in terms of the renewable energy sector. We'll talk a bit about Entropy Advisory. The next slide. So Entropy Advisory, the fund manager. The Renewable Energy Fund is a separate legal entity, which is a partnership and a fund. And as I said, Entropy Advisory is just the fund manager. The fund is actually owned by all of the investors that come in, and we just manage the fund on behalf of the investors. And having done quite a bit of work, especially when you had the load shedding boom, I should call it, although it was dire times, there were quite a few investors that would approach us to say, look, I've got 2 bar or 5 bar, and I want to get into a renewable energy project, right? Because obviously it was the buzz at that point in time. And there wasn't any vehicle, and still really isn't any vehicle for individuals to play in the renewable energy sector. And even though load shedding has dissipated in the urban areas, I mean, in the peri-urban and rural areas, it's still quite predominant. It's still a very good asset class, right, from an investment point of view. And as I said, this renewable energy fund allows you to gain access to that fund or to that sector. But importantly, it has this tax wrapper around it, which allows you quite an aggressive tax deduction. And in fact, it's your most aggressive tax deduction tool that you've got in the market. And if you couple this attractive asset class with this tax deduction that you're getting, and we'll expand on all of these things as we go on. Look, it's not a long presentation. We've kept it short, maybe 20 minutes, and then a bit of questions. And obviously, it's quite late, so we don't want to keep you here too long. But if back to my point, if you put the two together, this attractive asset class and this tax efficiency that you're getting, it does give you this very novel, very attractive investment, right? Which has the superior returns that we talk about. And effectively also it allows you to recoup your investment in the first 2 years. And we'll talk a bit about that and unpack that. And therefore, if you put all these elements together, it is a fairly de-risked investment. It's not a zero-risk investment, but it is a de-risked investment. And you could invest in it in any form, so whether it's yourself as an individual, through your practice, if you've got a trust, through a trust, if you've got a company, through a company. So your legal form that you come in could be anything, right? So if you've got a tax burden in your personal capacity, that's where you'd look at. If you've got it in your company or in your trust. So that's not restrictive. When I say targeted at individuals, it doesn't mean it has to come from your personal capacity. So just maybe a minute on in terms of Entropy Advisory, just a quick intro. Obviously, much more information in terms of our website, and we're happy to share whatever else you require. But Entropy Advisory is a boutique corporate finance advisory firm. So that's kind of where our roots are. The partners have all come out of the banking and fund management fraternity, and from different institutions, tier one institutions. I mean, like myself, I've been in corporate finance for close to 20 years with UBS, which is the International Investment Bank, and Standard Bank, and PIC even. Other guys have come from like RMB or Nedbank. But even in the team, I mean, myself, I'm an engineer, chemical engineer. We've got another engineer in the team. We've got a scientist in the team. So even though, the banking background, they've also got a technical background. And, it's a broad, we're sector agnostic, so we play across all the sectors. So there's two parts of the business, the advisory part. And, as I said there, we've had a strong track record in renewables. So we've advised on a couple of transactions, some in the REIT round as well. And on the fund management side, it's more focused on niche opportunities. So like this one, this renewable energy fund that has a good tax wrapper, there's something on social housing that we're busy with. So it's more, niche fund management opportunities that we tap into. I spoke about the team, within the interview advisory team, and even with our technical partners that we have, so engineering and technical partners that we have, there's a whole host of expertise across different disciplines. And it steeds you as investors quite well, because obviously you've got access to that, not just, as I said, from a financial perspective, but even from engineering perspective, which is quite key, considering that the fund invests into energy projects. So if really there's one thing that you want to take away, and the 2 minutes that you want to pay attention to this presentation, I think this is really the slide. Because there's two main reasons why you should be looking at this fund and what the fund can do for you. And number one is that it saves you money through tax savings, right? And I spoke about that earlier. So it's your most aggressive tax deduction tool in the market right now, and a legal tax deduction tool. There's no loophole that we found. So what it allows you to do is that it allows you to claim back a very aggressive tax deduction from SARS. So SARS, in order to incentivize investment into the renewable energy sector, there's a tax deduction that they allow for investment going into that sector. And SARS has incentives across different sectors and industries, from R&D to manufacturing. I think it's mostly focused on the industrial side, but these incentives do exist, right? So that's what the fund, the way it's structured, and as I said, playing into the renewable energy sector, it allows individuals to claim back that tax deduction, and it allows you. You'll see I'll talk about it, a 200% tax deduction, 100% this year, and 100% tax deduction next year. So that's why I said, from one investment, you can claim back a 200% tax deduction. So it's your most aggressive tax deduction or tax structuring tool that you've got in the market. The second thing is that it makes you money, right? So you get the tax deduction by investing in the fund, you claim that back, but you are invested in the fund, you're invested in the fund, and the fund, as I said, invests into projects that yield cash returns. And so you're actually making money from just being in the fund as well. That's why I said, the renewable energy projects are a very attractive investment asset class. And it allows you regular cash distributions. There's cash distributions every 6 months that we do from year one. And on average, there's about a 13% cash yield. So in other words, on average, you're getting about 13% of your return per annum back, depending on what your initial amount was that you invested in. So as I said, two things: it saves you money through the tax savings, because if you had a tax burden, either way, you're going to pay it over to SARS. You can route it into this energy fund and claim back that tax deduction from SARS. So if you paid it over to SARS, you claim it back as a deduction. If you provisional, for instance, you just pay less tax, right? So that's how it saves you money, and then it makes you money because, as I said, there's cash distributions. It's investing into projects that generate cash, and that's distributed out to the investors. So what does the fund do? So the fund, as I said, it's a renewable energy fund, but what exactly does that mean? So it invests into renewable energy projects. So let's take an example. There's a warehouse owner. He wants to put in solar. He doesn't know how to do it, doesn't know who to speak to, and also, more importantly, he doesn't have the capital to do it. He'd rather spend money on maybe expanding it, putting in new cranes, as opposed to putting in solar, which he now needs to then maintain and operate, which he has no skills in. So the fund comes in, we'll design a bespoke solution for him. We look at his load profile, we look at his roof surface, for instance, structural support. We'll design a bespoke solution that meets his needs. And then we will procure the equipment, we'll install the panels and equipment, and we'll operate it and maintain it. And we'll just bill him for his usage. So he pays zero capital, the zero capex outlay from the start. And he locks in a saving because before we do all of this, we do a proposal. We say, look, this is what your rate is going to be in terms of electricity that you're going to be paying. And 99.9% of the time, it's cheaper than ESCOM. And as the ESCOM tariffs increase 2 to 3 times inflation, that gap just widens. So he's locking in a saving from day one. He's putting in zero capex, and he doesn't have to operate and maintain this. That's the responsibility of the fund. So for him, it's a win-win solution. So that's what the fund does. So as I said, we'll own and operate that asset. We'll bill him every month for his usage based on, as I said, the agreed rate. So just like he's paying ESCOM every month, he's paying us every month for his usage. And therefore, it's very cash rich. So every month we're collecting cash. And as I said, every 6 months, we sweep that out to investors. So we distribute it out to investors. And that's kind of the mandate of the fund and what the fund does. We obviously don't invest in every project. So we'll screen the project. We look at how credit worthy they are. We look at the returns. We'll design it and price it accordingly. And importantly, we'll invest in different projects, but not just in solar, predominantly in solar, I'll be honest. But we've also got access to some novel technologies like waste to energy, so biomass and conduit hydro. Not new technologies, de-risk technologies. They, out there in South Africa, they're out there in other parts of the world. But where everybody's focusing on solar, we've got this not just project mix, but also this technology mix. Because the beauty with conduit hydro and biomass is that the returns are much better. So you get superior returns for that. The fund is, we're looking at raising a 200 million rand fund. We have raised last year. We started to raise last year. We raised a bit of capital last year. We've come back into the market now for this tax year. And we're looking at raising, as I said, a 200 million rand fund before we close the fund. The fund is still open. If you look at the main investment highlights, so minimum investment is 200,000. So generally, with opportunities of this nature, it's very much targeted at the ultra high net worth individuals. Minimum investment size is R1 million plus, right? So we've kept it lower to allow professionals in. Being a professional myself, being an engineer myself, I know you've got disposable income, but you don't see these attractive investment opportunities just because you never considered a market opportunity, right? You never marketed these investment opportunities. So we wanted to change that. We said, look, let's keep the minimum investment lower to allow a broader base of investors. We spoke about it in what it does, investing in terms of renewable energy projects, the diversification that you get. And as I said, we've got a couple of slides in terms of the numbers and the returns, but we're targeting return of invested capital within 2 years. So in other words, you invest R1 million, you get that R1 million back over 2 years. Actually, if you come in now, it's just over a year that you get your invested amount back, right? Because you're at the end of the tax year this year. And most of that is in year one, over 60% of that is in year one. So you very de-risked very early on in the investment. You get a pre-tax IRR of 38%, which is phenomenal. And I spoke about you get an annual or biannual cash distribution every year. And the fund life is 10 years. So for about 10 years, you get that. So it's, and as I said, on average, your cash yield, so that means your distribution that you're getting every year through these cash distributions is about 13%. So if you think about 13%, if you think about a money market, right, where you're getting cash regularly back from your investment, that's only at about 4 or 5%. I think currently, the bond market doesn't even give you close to 13% now. So it's a very attractive cash yield that you're getting, considering that you're getting cash distributions quite regularly. So I spoke about this tax benefit you get, and you might have seen I've mentioned it's a 12B or it's a 12B tax benefit. So 12B it's a code in the Tax Act, Section 12B. That's what it's called, and that's why it's referred to Section 12B. And as I said, I think the first thing to maybe appreciate is that SARS has tax incentives in various sectors for various things, right? These things exist. But what 12B does is that it allows you, as I said, these deductions if you invest into renewable energy projects, right? So effectively, SARS saying, look, I want to incentivize investment into renewable energy because we want that industry to grow. We want to, move to a greener environment, right, to allow us to compete globally. And so therefore, it allows these tax deductions. It was first introduced in 2016, so it's not something that's just come up. What they did do is they actually expanded it during the height of load shedding, and that ended last year. So, whereas now you get 100% tax deduction, previously you got 125% tax deduction, but it still continues. And as I said, it's been around for a while. I don't think it'll be around forever, to be honest. I think at some stage they will close it, but they aren't doing that anytime soon. So this year it's here. Obviously, the tax year it's almost ended. Well, the SARS tax year is kind of Feb. Next tax year it's around, and they haven't issued any sunset clauses for it, right? So they're not even thinking of closing it. So the point is that it's been around for a while. It's worked. Tax deductions have been allowed. I think like Murthy, who's on the call, he invested with us last year. He was able to get his tax deduction. So the benefit is there. The mechanism is there. As I said, it's not some loophole that we found where you really need to kind of angle yourself to get it. It is a mandated tax benefit that you get. So if you look at just, I think here is a kind of a simple example to say, look, what is the benefit, right? So from a tax perspective, we talk a lot about this tax benefit that you're getting, because we think investors should start there to say, look, what is your tax burden, and therefore what benefit are you getting just from a tax structuring tool, plus you couple on as the returns. So we've got two individuals here, one in this gray or green or whatever color you want to call it. So this investor doesn't invest in the fund; he just carries on, paying tax. And the other one on the right-hand side is this investor that does invest in the fund. So if we look at the first investor or non-investor, I should say, so he is taxable income is 5 million. as that he doesn't invest in the fund, so therefore there's no tax deduction from investing in the fund. So his taxable income stays at 5 million. And at the end of the year, this is the tax he pays, right? And there's obviously no tax saving. Similar investor in the same circumstances, same 5 million rand taxable income. He invests R1 million in year one, so in this year. He's allowed a tax deduction of 100% this year, so he gets the 1 million rands. So his taxable income drops to 4 million, right? So it's the 5 minus the 1, or minus the 1, and that's how he gets to the 4. So he is only paying tax on 4 million rands. So the tax due to SARS is this 1.6 versus this 2.076, right? And therefore his tax saving is 450. So that's what I'm saying. Either he gets a tax refund from SARS if he's paid it over to SARS already, or if he's a business or provisional, he just pays less tax. He doesn't pay, he pays this amount. So his saving is this. But in year two, the way we have structured it, the way we've structured the fund and with the capital structure and tapping into 12B, because 12B allows you to tax deduction on what you invest in the project and not what you invest in the fund. So because we bring in some gearing into the project, to bring in some debt, in other words, into the project, if we take the investor's 1 million rands, we can just very comfortably and conservatively put some debt in the project. We can, because of the way we've structured it, we can effectively do a 2 million rand project with just a 1 million rand investment from the investor. And that's what allows you the second tax deduction in year two. So just from the one investment, because we bring in the debt, we've said, look, we bring in the debt in year two, just to be conservative. It allows you the second tax deduction in year two, right? And that's why you get this 200% tax deduction. So in year two, you're getting a second tax deduction, which is, also works out to 450 on a 1 million rand investment. And this assumes, obviously, this investor is at the upper threshold of the tax sliding scale. So effectively, he's getting his money back in the first 2 years, right? And that excludes the cash distribution he'll get in for year one and the cash distribution he'll get in year two. And that's why I say it's your most aggressive tax structuring tool, because it allows you this very aggressive tax deduction just from one investment over 2 years. And last year, what we did is we actually gave the investors almost a 300% tax deduction, right? So this is obviously what we target and can achieve. There might be slightly higher, but depending on how we structure it. And last year, that's what we did. In the year one already, we put in the debt quite early in the project. We gave the investors almost a 300% tax deduction. But also bear in mind, in last year, I said your taxable deduction was 125% versus this year, which is 100%, right? So it does work. As I said, your certainty in life, as we know, is death and taxes. So if you have a tax burden, you're going to be paying over that tax to SARS. This allows you to invest in the fund and effectively reduce your tax burden. So effectively, SARS is saying, look, if you invest in the fund, because we're going to promote investment in renewable energy, we'll essentially give you the money to invest in the fund. And that's what it translates into. If we look at the profile, so, if we look at maybe the chart on the left-hand side, so this just shows your cash return over time. So as I said, a 10-year fund. This is your investment in year one. You get your tax deduction. As I said, you get your distribution in year two. You get your tax deduction again. And then your distributions, every year continue, right? But the important thing is that, as I mentioned, already within, as I said, if you're investing now within a year and a half or just over a year, you actually get your investment amount back. So you completely de-risk. You've got your money back. Now it's just this additional benefit that you're getting, this additional returns that you're getting. And your cash yields, as I said, the cash yield starts from year one, right? And it's a very attractive inflation-beating cash yield. So it increases above inflation over time. This, effectively gives you what I've shown in the charts in the slide preceding this in numbers. But I think what's worth focusing on is maybe this line here. So your return net of fees, you're getting about 2.3 times money back, right? So here the investment was 1 million rands. He's getting close to 2.3 million rands back over the life of this fund. So you're getting about 2.3 times money back. And as I said, importantly, you're getting a big chunk of that early on in your fund. Early on in your fund, and as every year goes, you're getting a return back, you're getting returns back, right? So over time, you're getting it. You don't have to wait for year 10, so whether it's, I don't know, RAs or any private equity investment where you invest the money and you have to wait 9 to 10 years and kind of hope that things panned out. And that's when you're getting one distribution. Here, as I said, from the beginning, and you're de-risking yourself. You're getting your returns every year, and you're getting a big chunk of it upfront, right? And a big chunk of it just from the tax benefit. And the tax benefit doesn't depend on how well the project is performing. So even if the project performs better, you still get the tax deduction. Project performs worse, you still get the tax deduction. And that's why, because of that tax benefit, which is fixed, right, which SARS does irrespective of the performance of the asset or the performance of the project, it does de-risk you quite early on, and therefore lowers your risk profile from an investment point of view. We spoke about this 38% IRR, and I mean, like a typical private equity fund would target about 20% IRR, right? So that's what I'm saying. 38% IRR is quite phenomenal. The project pipeline. So we've got a healthy project pipeline. I think the benefit has been that, as I said, we've been in the market, we've been in the industry advising on projects, and therefore because we've done enough, fair amount of work in the renewable energy sector, we have very good relationships in the renewable energy sector with project promoters, with EPCs, and therefore we are able to source attractive projects and have a healthy pipeline, and effectively kind of cut out the middleman. So we don't have to go to brokers to go and find us projects, because we're already dealing with the end client or the EPC themselves. So, I mean, this is obviously a snapshot in terms of kind of give you a taste of the pipeline in terms of what we've seen. So there's a healthy pipeline. There's always a healthy pipeline. And, get back to my point to say that we won't do every project that comes our way. We will screen it to make sure that it is investable, to make sure that it is low risk, to make sure that there is a good certainty in terms of returning that cash over to investors. So in terms of the procedure, fairly straightforward. I mean, I'm not really going to dwell on this, but you can email us, you can WhatsApp me. I'll give you my details later on. Whatever form, get a hold of us. There's the application form that we send through. It's fairly straightforward, the application form. There's a couple of PICA documents. But, even before that, right, as I said, there might be some questions here. There might be questions after that. Reach out to us. Either myself or any of the team members are available to, if you want a one-on-one session, if you just have a couple of questions, get on a WhatsApp call, get on a Zoom call, get on a Teams call, and we can answer all of that for you. Because we obviously appreciate that you need to be comfortable where you put your money. You need to be comfortable and go in with eyes wide open. And that's what we want. We think it's a good, fabulous opportunity, but be comfortable and go in with eyes wide open. So whatever questions you have, whatever queries you have, please reach out to us. This is not the only opportunity that you've got. So in conclusion, as I said, it's a novel opportunity, and therefore it's not mainstream. The fund sizes are generally small, and that's why you don't have the bigger players like your EPSAs, like your own mutuals playing in this, because as I said, our fund size is 200 million rand. That's too small a fund size for these guys. They'll look at R1 billion plus. But it doesn't mean it's not an opportunity, right? It's a good opportunity because, as I said, we're well placed in terms of being able to get projects, being able to project manage it, being able to make sure it's executed and comes online. So the fund is, as I said, a very unique but very attractive opportunity. Importantly, it allows you access to this renewable energy industry, which is still booming, still fairly attractive. It gives you this very aggressive tax deduction, which, that's what I'm saying, even from a tax structuring tool, it's your best tax structuring tool. Even if you say, look, the return's okay, but I want it for the tax structuring tool. So it gives you this very aggressive tax deduction that allows you to lower your tax burden. If you wanted to, you could pay zero tax, right? I mean, there's no maximum in terms of what you could invest in or invest in the fund. So you could, if you wanted to, structure it so that you pay zero or close to zero tax this tax year. And if you couple the two together, this very aggressive tax deduction, and as I said, this very attractive asset class, which is this renewable energy projects that give you regular cash distributions, that give you good cash distributions, that is a known technology where very little operational risk. I mean, if you put the panels on the roof, for instance, and the sun shining, it's generating electricity. There's no personnel that goes there. There's no strikes. There's no breakdowns. So it operates, and all of the equipment are backed by warranties. So, for instance, if there's a panel that's not working because we've got remote monitoring, we monitor it every day. We go in, we change that panel. It's backed by a warranty, and obviously we get back to full capacity. So, as I said, if you couple all of that together, it is a de-risk investment opportunity that gives you superior returns. There's my details here. But as I said, you can even go onto our website. I think if you joined the session today, you would have had my email address. So you can obviously just email me if you need to contact me. And I'll open it up now to questions. Is there any questions? I think just raise your hands and.
Evening, Nishal. It's Murthy here. I just got to go. I know there's 2 or 3 people that I've invited. It's Dr. Bagwandas, Dr. Mohatlane, and Dr. Suleiman. There's a good few else I've invited. So I suppose some of them may discuss it with me, still wanting to go further details in the event. They understand or just need further information. But it's good you shared your details. I'd prefer them dealing directly with you in terms of all the finer detail, all the application forms and things of that sort. But just to put people's mind at ease, those that particularly I've invited, I've seen the benefits. You recall, and I'm just saying this out of completeness, when I got involved in the fund last year around this time, it took me several weeks, and I did a fair amount of due diligence before I invested. And I seen the benefit of it when I filed my tax return, because I couldn't believe it was so good to be true. So I got the benefit of it, and that's why we discussed, and you said to me, don't you want to invite other role players who could be in your position? I said, no, fine. If this benefited me, I can't see why I can't invite others that could enjoy the same benefit, the tax benefit particularly. Thank you. Okay.
Yeah, no, thanks for that, Murthy. And it's always more impactful when you hear it straight from the horse's mouth. And that's why, I can preach or wax lyrical that it works and it's an opportunity, and there's no smoke being blown in front of you. But when you actually hear from a fellow investor that has seen the benefit, it's obviously much more impactful.
Yeah, I just want to say one final thing before I leave. I just want to say there's no conflict of interest. I've done this out of my pure, on my own voluntary basis, because you asked me for that. You've not offered me any incentives, and I refuse to accept any incentives because all I'm doing is the introductory. So anybody who's been invited, myself, or if you share a video to any of those who've been invited, they're doing it directly with you with no incentivize from my side. Thank you.
Yeah, no, thanks for that. Okay, so as I said, this isn't the only opportunity. Let it percolate, let it set in. If you need to, reach out to myself. I've as I said, reach out through my email address. If you do want my number, you might not have access to the chat thereafter, but my number is 072 509 4028. I'll put it on the chat as well. And even I know, as I said, there were a few that did email saying, look, they wanted to come on, but it is a bit of short notice. So we can do a follow-up session next week if need be. As I said, if guys just want to chat one-on-one, then that's fine. I have recorded the session. I probably will load it, or we'll upload it on our website as well, so you've got access to it there. I think we've also got a previous webinar that we've done, similar sort of format. So yeah, there's lots of content if you do want more information. There's also a fund brochure. Email me and I'll send it to you, failing which you can go onto our website and download the fund brochure. And that has the pertinent information, pretty much what we've gone through today on the presentation. So you do have material that you can look at, you can download, you can think about, you can discuss. And as I said, we're always available if you do want to have a discussion. Okay, so if there's no other questions or no further questions, then as I said, again, thank you for making the time and for sacrificing some of your evening with your family. I do appreciate it, and hopefully you do see the benefit, and hopefully we do see you as one of the investors.